Hey everybody, it is Rick and Michael. We are celebrating 10 years of audited actual investment performance. And so we wanted to answer the top question that we usually get about the fact sheets that we send out to you guys. They've been upgraded. We went to and got approved on Morningstar now so that we have all of this data inside of Morningstar. Most of you probably know what Morningstar is, but they're a little bit more in depth and a little bit more data heavy than some of what you might be used to looking at. So we wanted to take this opportunity to answer all of your questions at one time. I'm going to walk through the fact sheets and kind of go over what you're looking at and why it's special. And I want to keep in mind three things actually. We've just crossed our 10-year track record, which is like insane. Like most firms, first of all, most firms don't audit, almost no firms, I don't know of any, that audit their actual client investment performance. This is what you've actually done, not hypothetical, not an audited fund that we would have put you in. This is what you've actually done here at Heirloom. And it's 10 years. So the amount of firms that actually last 10 years with audited performance is, a fraction of firms. So we're super proud of it. We want to make sure you guys know what you're looking at. First and foremost, you're looking at the chart of the investment growth. So what this is showing just pictorially, the blue shadow is, how much you would have had if you started with 100, 10,000, 100,000, million, whatever you want to call it. The blue shade is up to like 215,000, 215. The red and the blue though are going to be thematically throughout. So the other darker blue or black is the U.S. Fund Global Moderately Conservative Allocation. That is an index that is used as a benchmark for this fund. So there's no fees coming out of it. It is a benchmark. Those are notoriously hard to beat, as you'll see. And you do see in this graph we're beating it. The red is the Vanguard Wellesley Income Fund, which is a best-in-class Morningstar 5-star fund, kind of like their best-in-class for this risk tolerance that you have. And we're looking at the Heirloom balanced approach here. So this is a 40% equity allocation. The rest is split between bonds and alternatives. So pictorially, you can see you have quite a bit more money, the Heirloom balanced, than you do the other two.
One thing that's important to highlight here, Rick, is that we're actually showing the returns net of the advisory fee.
Yeah.
This is not just investment expenses. We're spotting the index basically percent in a quarter almost per year.
Yeah, it's 1.13 is the difference in our gross, which we don't show you, and our net. So you guys are used to seeing this. We have only ever shown you guys net. So when I say, and we talk about like the Vanguard Wellesley's done this and we've done that, we're talking about what we've done after fees, and we are not taking that fee from the Vanguard. So we got one hand behind our back and we're still beating them. So Mike, walk us through the next box here, the trailing returns, and just walk through kind of what you're seeing here.
Yeah, the trailing returns are just that. They'll show on a year-to-date basis, which for our purposes here would be 2025. This is year-end 2025. So you see the returns for year-to-date match the 1 year. And then you see 3.5 since inception, which is the 10-year number. All of these we compare relative to the benchmark, the passive benchmark, and then Vanguard Wellesley Income Fund. The reason that we put that on there is not arbitrary. It's what Morningstar says is the gold rated, the top fund, their best pick in that category over the same time frame. So we're looking at apples to apples. How have we done over the long term? It's hard to say that after 10 years, that's not long term. So very proud of the data and their performance.
Yeah, so you're looking at 7.71, arguably it's 7.72 for thousands of rounding, but annualized, we're looking at 7.71 annualized performance over the 100%. Oh, it makes a difference, man. Over the Vanguard here is 6.16. So we have significant outperformance after fees over like the best in class fund. That might sound like, well, duh, we pay you to do that. Like, doesn't everybody beat their benchmark? No, it's very, very, very there.
In fact, and we can throw this data up. We compared the strategy over 10 years relative to all mutual funds, all ETFs, separately managed accounts in Morningstar's database. This is the top return strategy for this level of risk taken.
Yeah, we'll throw that up in a second. Portfolio holdings, pretty straightforward. You guys can see what we're calling U.S. equity, multi-alternative, all that, that pie chart there, and how you're diversified. You can click into each of these in your client portal, and you can see exactly what that is. Top holdings, Arrow done That's the managed future strategy that we've had for a while. That's kind of your airbag in the portfolio. That is actually your largest holding if you're in the heirloom balance approach, followed by Alphabet, Visa, Microsoft, Nvidia. And you can kind of see it's pretty self-explanatory, but those are the top holdings in the portfolio across the portfolio. Then we get down to some things that you might not be aware of. To start off, I'll talk about upside and downside capture. This is performance metrics 101. When you see an upside capture ratio of 103.28, that means we are capturing 103% of the upside compared to the index below it, which is at 100 and 100 upside downside. That's because that's what we're comparing it to. So you look at it upside, we're beating the upside 103 by 3%. And the downside is only 81%. So that means we're losing less. If you compare that to what the Wellesley fund, the best in class fund, is doing, they're only getting 96% of the upside and they're losing 87%. So we have more upside, less downside, which over a market cycle is significant as far as outperformance goes. Then Mike, what the heck Sortino, Sharp, Alpha, Beta?
Yeah, I'll walk through each one of these. Sortino ratio is my favorite metric to look at here. And really what Sortino ratio does is it's a simple ratio. On the top part of the ratio, we're looking at the return of the portfolio. We're going to subtract the risk-free rate from that. Okay. What are the excess return above the risk-free rate that you're generating? That's what goes in the numerator. In the denominator, something called a semi-deviation or downside standard deviation, meaning how much volatility do you have, to the downside when markets are down. The higher the number, the better return per unit of risk taken. So for me, when we're managing portfolios, the way that these were constructed, we like to call it the Miller Lite strategy. If you remember the commercials for Miller Lite, great case, less filling, more return, less risk. This summarizes that, encapsulates it in one single data point. Strategy is also the #1 Sortino ranked strategy in category. Alpha, this is a way for us to measure what kind of value that a manager's bringing to the table by making active decisions. You see that's 0 for the passive benchmarks. They're not making any active decisions. They're just investing the same holding, the benchmark is what it is. That's what we're measuring it against. Beta is a way for us to measure market risk. A beta of 1, if the market or benchmark in this case is up 1%, you would expect to be up 1%. If it's down 1%, you expect to be down 1%. So a lower than 1 beta indicates lower market risk. R-squared is a statistical term. I really like to put this on here for a reason that it shows that we're different. What R-squared does is as a statistical regression, looks at historical returns and tries to determine what percentage of the returns from this strategy can be explained by the benchmark returns. In this case, it's about 79%. That indicates that there's something significantly different that we're doing here. Obviously, incorporating alternatives, the way that we invest capital, and that comes through in the R-squared. So I love to talk about this stuff. I'll reel it in. Get me going on R-squared and Sortino ratios. I get all excited.
So to highlight, guys, you're looking at a Sortino of 1.1, much higher than the rest. Yeah, Alpha, we didn't really touch on Sharp, but Sortino is a better risk-adjusted tool there. Alpha, 2.39. I mean, there's significant outperformance happening due to the active management in this fund. Beta, lower. R2, like you said, we're doing something different, clearly. I want to put your attention to the handout on the last form of your packets. It's the peer group comparison. Mike's referenced it a few times. We're looking at the heirloom balance, annualized return 7.71, funds in the category. So we're competing against 205 funds here. This does not go, there's obviously washouts and things that have not been around for 10 years here as well, but the return rank out of 205, what you can find in this risk category, we're the #1 return rank. We're not talking about percentile, we're talking about the #1 choice, like the top choice. Alpha, #2. In #2 choice as far as Alpha goes, and Sortino, that return for unit of risk number, how careful are we what we're getting those, #1. That's crazy. Mike's our CIO. I want to brag on him, but that is literally insane. And our biggest challenge frequently when discussing our performance is how special it is. And we really want to make sure you guys are equipped with the tools and knowledge to know that what you're looking at is really not typical. This is pretty special stuff. So we're very proud of it. The second page of your packets here for the balanced fund, for instance, is just pictorially how we're going to rank performance relative to group. We just talked about that being special. If you look at year to date in 2025 are the same things. We're looking at 2025 here. But it's just going to be the inception on the far right there. You see the blue dot is obviously heirloom. We are above top quartile because we are the #1 choice. Peer group ranking right below that. another picture of, where we rank in the peer group. Obviously very, very high, well above the best in class, Morningstar fund there, the Vanguard. So we are literally the best choice across the board here.
I wish that the year 2020 hadn't dropped off on this chart. We include 5 years. There's no option in Morningstar to do 6, but the 2020 through 2022 timeframe is really where we delivered outperformance in other years, but the pandemic, lost less, rebounded sharply. Our strategy did very well following the pandemic. It wasn't just losing less, it was making more after that. And then, 2021 caught the rebound, and in 2022 was a very difficult year for both stocks and bonds. Very different timeframes that were difficult for different reasons. You had the pandemic, you had the inflation spike, that followed after the central bank money bazooka came out. We're able to deal with very well, even though 2020 was very different in 2022. The strategy really shined in times of turmoil.
Yeah. Bear market performance is the next little thing here. Mike, why don't you walk us through like up period, down period, max drawdown?
Yeah, this is going to be on a monthly basis. What percentage of those months over the last 10 years were you up? What percent were you down? You can see that the numbers are relatively similar across strategies here. What stands out when I look at this table would be the maximum drawdown. And what that looks at is over the last decade, what was the worst decline that you saw, not on a calendar year, but from peak to valley before you recovered? For our strategy, it was down 12.39%. For the index, it was 5% above that, 17.59%. And for the Vanguard Volatility Income Fund, it was a little over 2% above the maximum drawdown that we experienced. So if you wanted to have the numbers, you got higher return, lower downside risk. We looked at the downside capture ratio, and the maximum drawdown was significantly less. So when I'm thinking about our clients, prospective clients, what they're looking for in their investments, right? They want high return. Everyone knows that, but they also want less risk.
Yep.
Okay. It helps stay invested, greater peace of mind. It's just easier to live with a portfolio that's like that. And that's what we set out to design and implement over a decade ago. And I'm proud to say, today that's what we've delivered over the long term.
Little inside baseball for you guys, but we've put a lot of effort into this. Obviously, we're very proud of it. We want investments to be a part of why you're with us, but not the only part. Obviously, we take pride in a lot of the other stuff that we're doing for you guys. If you're with us, you've experienced this. If you're not, you should experience it. If you've got friends or family and you see these, hopefully you have some ammo into what you're actually looking at.
Like what I would just interject here is like past performance will not guarantee future returns.
Yeah.
Okay. But I think this is important. It's a long enough time frame to show that the process that we're using, it works. And I think it will continue to work well into the future. To your point, the performance, like on a standalone basis, if you were not even working with an advisor, you would have been happy with this investment selection that we have here. But you add in, okay, we've got an advisor that can work with you on financial planning, retirement cash flow distributions, saving strategies, tax mitigation. I don't know of another firm out there that's delivering more value to their clients tangibly than what Heirloom Wealth Management is. And that's what I'm most proud of.
10-year.
All right, let's go.
See you guys later. Thanks.